Welcome back. Some investors fear the current Israel-Iran conflict could lead to a wider war in the region and has the potential of U.S. involvement. All of that, they fear, could trigger a market meltdown. Our next guest, however, has studied geopolitical shocks like wars and terror attacks, going all the way back to the Japanese attack on Pearl Harbor in 1941. He says stocks have historically been resilient after such traumatic geopolitical events. We're joined now by Jeff Buchbinder, Chief Equity Strategist for LPL Financial. Jeff, thanks a lot for joining us. What has your research shown about markets and their ability to get back on their feet after perhaps taking a severe hit following events like the attack on Pearl Harbor, the Cuban Missile Crisis, the shooting of Ronald Reagan, the 9/11 terror attacks, and many others that you've studied?
Yeah, well, first, thanks for having me on. The research is pretty clear, especially over the last 3 or 4 decades, that the economic environment actually matters perhaps more than the geopolitical shock. So let me give a couple of examples. The first Gulf War, 1990, the market sold off a little over 10% during that period, but that was a very challenging economic time. So we would argue that that weakness was due more to the economic environment coming off of the savings and loan crisis rather than the fears of a worsening conflict in the Middle East. Certainly 9/11, another example that many of us painfully remember, that was immediately after the dot-com crash and right at the beginning of the recession during 2001. And then the subsequent accounting scandals of Enron and WorldCom. So you can attach those sell-offs to that period of time and those economic events. If you go back further, it's really oil. That's the way that these events are transmitted to economic weakness. So 1973, the oil embargo is a very good example. The U.S., of course, is energy independent now. Oil shocks aren't going to have as big of an impact on the economy or corporate profits. So I think that's why you're seeing this market be much more resilient to this particular episode. It's a very emotional time, of course. We don't want emotions to drive our investment decisions. But if you step back and you look at history, as long as you're not in or about to enter recession, stocks actually manage through these events quite well. It's really the economy more so than the geopolitics.
And we're just showing as you're speaking some of the highlights from a large table of information you provided us with that show, for instance, the S&P 500 12 months after Pearl Harbor was up over 11%, about 11.5% after the Cuban Missile Crisis in the early 1960s. S&P 500 up 32% 12 months after. After 9/11, it was a different story. The market was down by 11.2%, 12 months after 9/11. The average for that, the average gain in the S&P 500 or change in the S&P 500 12 months after the events that you have studied, up almost 8%. So in this conflict, what should investors be watching from a market point of view? I'm hearing you say they should be watching the price of oil. It's up to about $75 US. That's still not a 52-week high for the price of crude oil that we're looking at it right now. The high was about a year ago, which was very close to $84 US per barrel. So we have not seen an explosive rally yet in the price of crude. How would you interpret that?
That just suggests that this market thinks that this conflict is going to be contained. Now, like many of these other conflicts, it could drag on for months. Typically you see a drawdown of about 4 or 5% in the S&P 500 over the course of perhaps 2-3 weeks. The recoveries typically take about a month and a half, give or take. That seems to be a reasonable expectation this time. But again, if this conflict remains contained, and the market expects for it to remain contained, then you're likely to see, just a little bit of a dip. We would potentially consider buying on weakness there, and then we could potentially be back at all-time highs within the next month or two.
What about the possibility of a regime change in Iran? That current leadership is forced out. That, as you know, is becoming a talking point. There have been fairly serious protests by the Iranian population against the regime in recent years. The population has not been timid in recent years about expressing its opinion about the regime. Is there a clear market takeaway from a scenario in which the theocratic regime is forced out?
Well, you're going to hear the term peace dividend thrown around. There is the possibility of a safer and more economically thriving Middle East on the other side of this. But certainly we're not military strategists. That's really hard to predict. We're just going to follow what the markets tell us. There's a number of ways this could be contained, and you really just have to balance the risk reward. So, with a stock market that's pretty expensive, has had some really strong gains here recently, we think we need to digest those gains. Not only are we pricing in a pretty optimistic scenario on oil prices in the Middle East, but also on tariffs and trade policy uncertainty. We do have the catalyst later this year, potentially, of a tax bill, more deregulation, more investments in artificial intelligence. Those factors we think will drive us higher, potentially to all-time highs and beyond. But in the very short term, we really need to watch oil prices, just see how this plays out. As long as it remains contained, we think we're looking at maybe a 5% pullback, possibly a little bit more, but we would expect those losses to be recovered fairly quickly.
Well, what's it telling us? Your work shows that, I believe it shows that the typical market reaction to a shocking geopolitical event is a market drawdown in the short term and then a rebound in months following, including 12 months following. What's it telling us that the markets have just chugged higher throughout this whole thing, from before this attack was launched by Israel through the period of conflict through to today?
Well, unfortunately, we're used to Middle Eastern conflict at this point. So the market's a little bit immune. We've seen these events over many, many decades. Certainly a lot of folks are comparing this to 1967, 1973, and beyond. So there's a little bit of that probably helping the markets. But really, we're fundamentalists. When you get right down to it, it's economic growth and corporate profits that really drive markets higher. And the market, if it doesn't see that oil prices are going to be translated into economic weakness, then again, good chance that we continue to head higher. Market still expects, maybe 1.5% GDP growth over the next year or so, potentially 5-6% corporate profit growth. That's roughly in line with LPL Research's expectations. That is certainly enough to support this market, along with the catalysts that I just mentioned, and push us higher. We'll just have to watch oil. That's the risk. It makes the Fed's job very difficult here because they have tariff inflation that's very tough to gauge, on top of the uncertainty in oil prices around the events of the Middle East.